Ashvin Chhabra, in your book, The Aspirational Investor, you say too many people focus on beating the market instead of achieving their goals. How do people get lost along the way?
Well, I think, Greg, that they think that they're trying to achieve their goals by investing in the market. But really, people, when they invest in the market, only care about two things: safety and making a lot of money, right? So they're fixated on those two things. And unfortunately, they do that exactly at the wrong time. So when the market's crashing, they suddenly start worrying about safety, they start selling. And when there's a bubble, dollar signs appear before everybody's eyes, and they start investing everything they have into stocks that are growing the fastest. So that's a well-known strategy called buy high, sell low, with obvious consequences.
And talk about your wealth allocation framework. How does this solve the problem?
So I went back and I tried to understand, why is it that very smart people who are good at what they do, when they go into the market, they end up with these crazy strategies of selling at the wrong time, buying at the wrong time. It's like all your instincts don't seem to work. They work in everyday life, and that's why you're successful. And suddenly when you go into the market, you're doing everything that's the opposite of what you should be doing. And so I asked myself, I said, why are people in the market? Like I mentioned, it's really either for safety or to make a lot of money. And making a lot of money is a proxy for improving your lifestyle, securing your lifestyle, going to the next level. But the traditional framework, which comes from the brilliant work of Harry Markowitz, right, of a diversified portfolio, is really designed to give you a good rate of return over the very long time, based on rebalancing, based on making sure you don't exit when your stomach is churning, making sure you don't get too greedy. And so I separated out and said, let's create three portfolios: a safety portfolio, which ensures safety and liquidity; a market portfolio, which is fully diversified and gives you a market return; and then an aspirational portfolio if you really want to take those bets or those lottery tickets. And so this concept, which I call risk allocation, really deals with a lot of the behavioral mistakes that people make.
Why don't you talk about how you fill up those three different buckets? What do you put in there? Mutual funds, stocks, and how do you do it? Talk about your asset allocation within those three buckets.
So think of these three buckets as a concept called risk allocation, right? You're allocating risk and you're allocating resources or the money you have. It's your complete balance sheet. And so you ask yourself, what is the purpose of your investment? And if your purpose is safety, then you put in the safety bucket, and you will expect a zero rate of return because you're buying insurance. And there you're going to buy things like treasuries because you want real safety, or that's cash, and you will get safety at least in the short term. Now, in the market bucket, you're looking for a diversified set of investments. The reason why people invest in the market is they get the growth of the world, and they have to do that over the long term and be diversified. So it doesn't matter whether you do it by mutual funds or ETFs, whether you do active management or passive management. You just want a strategy that you're comfortable with, that is diversified and represents the world, right? And then the aspirational bucket really is if you have stock options, if you have a business, you have a small business and you want to grow it. Those are things that are designed that, if they're successful, will give you a very high rate of return, but they come with a lot of risk.
So finally, should investors sort of block out all the noise, the day-to-day noise, and just focus on the goals, on the end games for those particular buckets? Is that the best way to make sure you achieve your goals, as opposed to try and shoot out the lights?
Absolutely. So there are two lessons here. One is that the market doesn't care about you. So why do you spend all your time trying to beat the market, right? You really want to achieve your goals. The second lesson is, if your goal is safety, you're going to have to design a portion of your portfolio very differently than if your goal is to shoot out the lights. And by the way, if you want to shoot out the lights, don't invest in other people's businesses. Build your own business, or be an executive in a company that's giving you stock and stock options, which you hope will turn out well, right? Because what you need to shoot out the lights is leverage and concentration. And in the market bucket, those are precisely the things you're going to avoid.
All right. Thanks a lot, Ashvin. Congrats on the book.
It's a pleasure. Thank you very much.
And thank you for watching The Street.